Hello and welcome to this brand new episode of Smart Money. Now, 2022 was a year in which indexing and other traditional investment strategies faltered, and a year when quantitative investing offered a bright spot. This week on Smart Money, we do a deep dive in quant investing. Now, quantitative investing uses algorithms to analyze massive amounts of data like valuations, quality, liquidity, yields, and the speed of price changes, and then systematically makes trades based on this very analysis. By definition, this means that trades are grounded in historical data. How then will this approach fare in a potentially volatile market with few historical precedents in 2023? We have our guest joining us right here in the studio, Siddharth Vora, who's the Head Investment Strategy and Fund Manager PMS at Prabhudas Lilladher. Siddharth, thank you so much for being with us.
Thank you so much for having me, Sonia. It's an absolute pleasure to have this conversation.
It's a pleasure to have you here in the studio, more so because, quant is known to be the future of investing. Tell us a little bit for a layman, right? Because this is a show of financial literacy. So for a layman, what exactly is quant investing and why is it important?
So the way I see it, 20 years back, we asked around people to get somewhere. Navigation didn't happen with Google Maps. It happened if you remembered the roads, if you actually asked people around. What Google Maps did to navigation, quant holds the potential to do that to investing. Because when you're running a quantitative strategy, you don't have to remember everything or rely on your judgment to process vast amounts of data. You can teach your machines how to process data and how to react based on that. So it takes the whole emotion, greed, fear, biases out of the decision making and makes you a very sustainable, process-driven investor rather than a gut and intuition-based investor. So that's the key difference of how we see quant. Life with Google Maps and life without Google Maps.
I can't imagine my life without Google Maps anymore.
See?
So I guess a day and time will come when you won't imagine your life without
quantitative investing.
But as you said, it removes a lot of the biases, and there are so many, right? There's behavioral bias, there's familiarity bias, and there's just simple human emotion that comes into investing. If you want to eliminate that,
right,
how do you do it? How does quant investing work?
So I'll give you an example and then come to this point. So what we see is every investor, active, fundamental driven investor, develops a particular style of investing. And they tend to follow that through and through cycles. In a decade where value has underperformed and growth and quality have outperformed, the human mindset automatically tends to think that, okay, only growth and quality works. But when a regime changes, when the macro, monetary, valuation regime changes, what we see is that growth and quality starts underperforming and value stocks start outperforming. So for an active investor, it's very, very hard to change his style. But for a quantitative machine, which is trained to think in terms of regimes, in terms of asset allocation, in terms of styles, in terms of factors, it can evolve itself. And adaptability is what we really look for in quantitative investing.
So I guess when you talk about quantitative investing, right, and correct me if I'm wrong, you assess a certain trigger based on historical data.
Right.
When there's not so much historical data available, what do you do at a time like this? So I'm just trying to understand, why is it better? You said that quant investing is enabled by vast data, accurate processing power and rules. But if there is not enough data for a particular outcome, then how does it work?
So in US, we have data worth 45 years. In India, we now have data close to 20 years. Okay. So a decade back, quant might not have picked up. But as of today, where we stand, the availability of data, the availability of technology, and the availability of talent that can blend the technology, add its investment insights, and create a powerful combination of human insights and quantitative rules. That is the difference where we stand today, that we can blend processes and human insights, because there are multiple ways of quantitative investing. For mathematicians, statisticians who have no knowledge of markets or investment, even they can build quant models. But for them, they are not trying to understand market behavior. They are trying to solve a mathematical equation. And we refrain from that method of investing. We follow the quantum mental investing, which is deep-rooted in fundamental analysis, technical analysis, and logical set of rules, rather than solving a mathematical equation or optimize a backtest to get better returns. That is not how we work. And that is the real difference of how today is very different from 10 years ago in India.
Okay, tell us a little more. What are the different building blocks? What are the factors that you use in quantum mental investing?
So the way we look at it, it's macro factors and equity factors. When we look at macro factors, we're talking about growth, liquidity, risk, valuation, and trend. These are the 5 big macro factors that people can use to build asset allocation models. And when we come to equity, there are multiple factors such as quality, volatility, valuation, momentum, growth, dividend, size, etc. So what all these factors are simply financial characteristics. When you look at a person, you'll be like, okay, this is a tall person, this is a fair person. So this is exactly what factors help you do. They break down financial securities into financial characteristics. And when you find a way to convert these financial characteristics into an investment cycle or a decision-making process, that is simply how quant investing works.
Okay, I have one fundamental question. I know it may sound silly, but right now, quant investing is working for certain people because they have that edge, right?
Right.
They know how to make quant models.
Exactly.
Once everyone starts to know how to make quant models, and how am I going to generate alpha?
Okay, so that's a very important question. So let me break it into 2 segments. Firstly, all the most seasoned investors who've been around for 20, 30 years, they have a lot of experience, but for them to now think quantitatively is going to be very hard because they've already in the momentum of investing in a certain way. When we talk about the new generation, you need people who can decode markets, stocks, sectors, everything in a process and granular aspect. And everybody does not possess the capability of understanding markets and leading it back to a cause and effect relationship. Till you cannot build a cause and effect relationship and then convert it into a quantitative process, it's very hard. So even within quant, there are close to 150,000 methods of differentiating your strategy.
Wow.
So it's
there
very
are different factors that you look at. Fine. Let's dive straight into the style factors, right? You talk about size, quality, growth, volatility, value, and momentum. Tell us a little more about that. I mean, what are these factors? What are the different style factors?
Okay.
And as an investor, if I want to start investing in quant funds, what should I look at?
Okay. So there are 2 questions. I'll handle them
separately. Let's go to this investing in quant funds later. First, you tell us about the style factors.
So, quality is a very simple factor to understand. Everybody tells you in common sense that buy high quality companies. So that's one aspect. That's one characteristic. Quality refers to leverage, return on capital, capital efficiency, a lot of other metrics which tell you that this is a high cash generating business. It does not need debt. It's capital light. It's capital efficient. That's what basically quality tells you. But investing is not so simple because you need to get multiple things together. And the analysis we've done and probably shown, it tells you that using any single factor approach to investing will always underperform using a multi-factor approach to investing. Which means if you can blend quality, value, growth, and momentum, that's a very, very powerful combination as compared to only quality, only growth, or only value. You cannot see things in isolation. And other than that, the factors of growth basically include how a particular company is growing compared to its own history, compared to rest of the companies in India, and compared to its sectoral peer set. When you get that, you understand that this company is growing well. Valuation again tracks the value of a company related to its history, related to its peers, and related to its industry. And like that, when you combine so many different data sets, you can build models that help you navigate changing regimes, changing styles, and changing macros.
Okay, so this is very interesting, because when you talk about just quality, right? I mean, look at names like, say, an ITC, an HDFC Bank, an Asian Paints. If you take a last decade, these guys have not performed at all. A great quality companies, bluest of blue chip names,
exactly.
Right? Okay. But
so quality doesn't guarantee performance.
Quality doesn't
guarantees protection of capital.
But even value doesn't guarantee performance, right? I mean, PSU banks, for example, for the last decade have had great value in them. Valuations have been low, but they've done nothing for a decade, and now they've started to perform.
Because it's a regime change. The regime change is a monetary cycle is changing. The inflation cycle is changing, the growth cycle is changing, and the credit cycle in terms of NPAs is changing.
But how does an AI pick up, how does a machine learning
It's very
pick
simple.
Up
It's honestly very simple. So there's a factor, it's a proprietary factor called theme.
Okay.
So what our analysis tells us is that when you get the theme right, your probability of generating positive returns is more than 70%. So to find the worst stock in the best theme is better than the best stock in the worst theme, to put it very simply.
Okay, got it.
So if you get your theme right, that PSU bank long is your theme, if your model captures that, then whichever stock you get is going to do better than a private bank.
So are you trying to say that your model can capture the PSU bank theme, but the human emotion can't? No, I'm trying to say like in general.
Okay, last decade, they've not done anything. Why should we look at them? They are capital destroyers. They are not capital efficient.
Yes.
Emotions come in, biases come in, past experiences come in. The moment you take all that out and let the data talk, the model will tell you, okay, there is valuation in this. The monetary regime is indicating that you prefer a value investing style rather than a growth investing style. So for the last year, growth has delivered, as a factor, has delivered negative 22% returns. Value has delivered positive 23% returns. So this is a shift in regime. So now all the growth investors will be like, I picked the best stock, but you got your regime wrong. Now you're done.
So are you saying that fund managers who run active mutual funds, they don't consider all of these put together? Value, growth, theme, they do that, right? I mean, that's their basic job. So
they do that, but not
different?
with the scientific rigor and the disciplined process that is needed. Because see, sizing, stock selection, regime selection, factor selection, sector identification, exiting, there are liquidity risk. There are multiple things that go into making investment returns. It's not so simple that I identified one good stock and now I'm going to make money. No. If I allocated 1% of my portfolio or 20% of my portfolio, that is going to differentiate the alpha. So when your machine is trained to take all these decisions in a very top-down, structured, scientific manner, the outcomes are more predictable, they are more consistent, and they are more reliable. As a human, I might react differently in different situations to the same data, but a machine will not break the mold.
Are you trying to say that fund managers are going to be jobless, like traditional fund managers, if they don't keep up with the quant strategy?
No, I'm not trying to say that. There'll always be a market, but US does suggest that. Computers are managing more money than humans. Passive, so the pecking order in US in terms of growth and market share over the last decade, so quant has grown at a 19% CAGR over the last decade in terms of AUM. Passive has grown at a 12% CAGR and active has degrown at a 2% CAGR. So there are multiple reasons, right? Performance, alpha, cost of that performance, subjectivity of that performance. Because usually, how does anybody select a fund? Is it performing well in the past? I think it should perform well in the future.
Absolutely.
So in the last 3 years, if a quality fund manager has done well, everybody will be like, let's put here. The cycle has changed. Now stick in quality for 3 years, wait till you get your cycle back.
Absolutely.
So there's a lot of pain once you enter the wrong regime.
Okay, Siddharth, you've convinced me about quant funds you have. And for all of you who are doing like active fund management or who are into sort of active mutual funds, guys, the tide is turning and perhaps quant funds are the future. Let's do one thing. Let's slip into a short commercial break. Don't go anywhere. We'll come back with our guest in just a bit and talk more about quant investing, which is the future of investing. Stay tuned.